You might be wondering, what are discount points? A lot of people ask this question, they don't understand what discount points are. So let's go over it real quickly. Discount points are essentially a charge for you to buy down your interest rate. Now, whether or not that makes sense, I will help you understand that. All lenders, when they pull up the rates, they have a rate sheet. And then it has a list of rates from the lowest that they can offer up to the highest they can offer. Typically, somewhere in the middle of all this is the par rate. So that's going to be the lowest rate they can go without actually charging any discount points. Now, this is normally what a lender will offer you, but some lenders will also offer a rate that charges discount points. So each time you go down by about an eighth of a percent, there's a certain charge to that. Now, it's different on every single scenario. There's not a specific, hey, this dollar amount gets you this much down. Every single scenario, it's going to be different. So on the rate sheet, it's going to show all the lower rates, the cost associated with them. Some people like buying interest rates down because maybe the house is going to be long term, they're going to be there for a while. Some people just like getting the lower rate as opposed to whatever the par rate is. Now, as far as it making sense or not, you have to compare the cost of the discount points compared to the saving you're getting on your monthly payment. So, for example, let's just use a random scenario here. Let's say that it costs $1,000 to buy down the interest rate, and that buy down is only saving you about $10 a month on your payment. So that's about 100 months to recoup that. Basically, you need to save that $10 a month payment for 100 months just to break even on the $1,000 that you spent to buy it down. So 100 months is roughly about 8 years. So what that means is if you spend that $1,000 to buy your rate down and it saves you $10 a month, you have to be in your house without refinancing, selling, doing anything with that loan for a minimum of 8 years just to break even. My personal opinion, that is a very long time. Typically for discount points, I want to see the recoup time within 12 to 24 months. Because a lot of times, even if you plan on staying there for a while, you don't know what's going to happen with life. Some sort of change can happen, which makes you have to move, sell right away. Also, a lot of times people end up refinancing. Rates drop down lower. Maybe you've lived in the house a while, equity's built up, and now you want to take cash out, so now you're redoing your term over. So paying a big chunk of discount points and having a long recoup time doesn't always work out. So this is essentially what you need to decide when looking at whether you should pay discount points or not. You want to see what you're saving, what it's costing you, and then what the recoup time is on that. And then make a decision for yourself whether you're going to be in the house that long if you don't see rates dropping down during that time period, because once again, that will also ruin paying down the discount points. In this scenario, if you spend $1,000 to save the $10 a month, and then a year later the rates drop down lower to what you bought the rate down to, you just wasted that money. So you have to put all these factors together. The loan officer you're working with should be able to provide these numbers for you and go over this with you, but you shouldn't just go blindly paying a bunch of discount points, even if the rate seems really good, without considering these as a factor.